So we have had a really strong rally. It does look sticky, but it hasn't changed what the Fed has to do. It hasn't changed where inflation will still be, at the end of the year and for most of next year, which is definitively not at the Fed's target of 2.5% likely. And so I think there's going to be continued volatility. You're going to still have to be choosy. We still have a preference for high quality in this kind of environment because, the worst of what this could have been might be behind us or might be priced out of the market. But I still think it's a challenging environment. Very challenging macro environment, very challenging for these operators of companies, as you're talking about. And so I think don't get complacent. The same advice to the Fed is the same advice that investors should be heeding right now.
Sylvia, some of the most bullish observers of this rally, I think, are pointing mostly to the behavior of the market itself and the message that might be sending, just how broad the rally has been. There's been some persistence in it. It's rebuilt technical momentum to some degree. And historically, when, the broad indexes have regained more than half of a bear market decline, they tend not to have gone back or at least broken below the prior lows. Does that carry much weight for you? What else are you looking at to help you decide whether this might last?
Good morning, Mike. I do think that holds a lot of weight, actually. The first positive sign was when we broke through that 50-day moving average. Now we have NASDAQ up 20% from lows, S&P 15%. We've gotten a good amount of the lost performance that we saw since June back. And we've also seen a broader recovery. So now it's sort of, broad-based in terms of what people are buying and price appreciation in stocks. You just had that great stat up there where 78% of names have beat on profits and more than 90% have reported. These are all good signs, including jobs, right? So I do agree, with the sentiment that the Fed has a lot of work to do. CPI remains high, PPI remains high, but we did get that read coming down. We do have a strong economy. Michigan data is better. The consumer is stronger, spending and services. So I do think you're going to get slower growth, near-term volatility for sure. Any news headline can touch the market and impact it positively or negatively these days. But I don't think we're going to retest those lows. And I do expect us to end up on the year now.
It is worth noting that if we do just retest the lows, which would, by some lights, be a pretty routine thing, Ross, it's a 15% drop from here, and most likely if you're dropping 15%, you think it could get a whole lot worse. So that's on one side of things. On the other side, we could still gain another 10% and still be down on the year, and we're going to look back and say 2022, that was a rough year.
Yeah, it's funny. It's funny how the narrative at the end of the year can shift things. I mean, 2020 is a great example of that, right? Big crash in the beginning of the year. But with hindsight, you've got an 18% gain in 20 years. That'll be the story of that year is a nice gain. So I think, look, earnings have put a floor under the equity market. You do have a couple of those great breadth and technical stats that, throughout history have meant, all right, we're not going to at least subsume the lows and make a new low. I do think that based on potentially some of the domestic political volatility and the potential for CPI to not cooperate. A lot of that move was energy. That can very easily reverse if something on the geopolitical front happens. So, I think there's still kind of catalysts out there that could send the market a little bit lower, at least into some chop. But we're definitely longer term bullish at this point. I think the consumer's in a good place. Companies have shown a remarkable resilience, not just operating through the pandemic, but through this recent bout of macro headwinds with inflation and the dollar. So we're pretty optimistic, but I do think lower growth and just kind of checking those expectations at the door is going to be important for the next 6 to 12 months. And then once the Fed pivots, we can start to have a new conversation from there.
Sylvia, if you're taking a fresh look at what you own or might own at this point after all these moves we've seen, what looks relatively better or worse to you?
Yeah, so I still like the mega cap tech names, the Apple, Microsoft, Amazon, Google types of names. I think that they have strong balance sheets. They have, secular growth participation in the future. Just absolutely crush earnings, even though they felt, lower than they have in the past. I think given the environment, what they put out was really incredible. I'm also dipping into semiconductors. I've said this a couple of times and they've gotten beat up since, but I just think without semiconductors, you have no 5G, you have no electric vehicles, you have no, data processing, quantum computing, things like this. And I think that these are, major things that we essentially need to move society forward in technology, and you need chips for all of it. And then, with this new Deflation Act, I mean, some of the hydrogen stocks out there, like the Plug Power and the EVGOs, those are going to have some really interesting performance, I think, in the near term, just because they're going to be pumped with money from Washington. So those are some of the names I'm looking at.